Good afternoon, everybody, and welcome to our webinar this afternoon featuring Eric Strait, The Pillars of Your River of Wealth. And thank you to Wellworks for sponsoring today's webinar. Before we begin, a few quick notes. We'll be recording this webinar and we'll be sending you a copy of the recording afterwards in a link. So if you missed something, don't worry, you'll be able to review it again in the recording. If you'd like to ask a question, please use the question and answer button you'll see at the bottom of your screen. But we have already received a number of questions in advance of today's webinar. Eric's going to try and address as many of them as he can after he does his presentation in the beginning, but we're going to try and keep today's webinar to under an hour. So if we don't address your question directly, someone from our team will try to follow up with you and answer your specific question. With that out of the way, let me introduce today's speaker. Eric Strait is the co-founder of Concentus Wealth Advisors. Based outside of Philadelphia, Concentus is an independent SEC-registered investment advisory firm with over $500 million under management. Eric's a graduate of Amherst College and has been in the financial advice business for over 25 years. He's a certified financial planner, a chartered financial consultant, and is the author of 3 books on investing and financial planning. He's been featured or quoted in a number of different publications and media outlets and has appeared on CNBC's Worldwide Exchange, CNN8's Money Matters Today, Fox News' America News Headquarters, among others. So let me welcome Eric. Hello, Eric. How are you? Oh, can I hear you? Are you there, Eric? Oh, there you go.
There we go. Number 1 is out of the way.
Although we're having a little trouble with the sound, Eric, can you make sure the microphone is right?
Can you hear me?
That's better. There we go.
Okay. All good? Just flag me if not. I was saying the first hurdle in a successful presentation in the world of coronavirus is getting your Zoom technology properly set up. So hopefully everybody can hear me. So I am Eric Strait. I'm the founder of Concentus Wealth Advisors, and our firm specializes in helping families to build a financial strategy to grow their wealth so that they can achieve the things that are most important to them in life. So before we get started, I just wanted to let you know how excited I am that you're all taking the time to attend today and to launch this program. What I've learned over 30 years doing this is that almost every American wants to achieve financial success in life, but that very few people are actually willing to put in any time and effort into their financial wellness. So the fact that you're here today shows that you're willing to take some action to actually secure your financial future. And that's what's really important, is taking action. And it's an honor for me to try to help you to do that. So today is the first session in a series of financial wellness webinars that we're going to do throughout this year, once a month, which I'm hoping will provide you with a comprehensive education and some actual practical advice on how to improve your personal financial wellness. The mission of the program is going to be to help you to develop a plan to achieve financial freedom at some point in your life, which I define as accumulating enough wealth to produce an income stream that you can never outlive. And the pursuit of this program is to help you to set a goal for that, and then to create a plan to achieve that kind of financial freedom in your own life someday. Although I know that probably sounds impossible, anything is possible with a little education and some of your own commitment. So as we begin the journey to financial freedom together, the first thing I'd like to do today is to lay a foundation by explaining some of the philosophy about wealth planning and investing that our firm has developed over 200 years of collective experience, in the hopes that our philosophy may provide you with some enlightenment about the real issues which are going to impact your financial future. Then in future sessions throughout the year, we're going to lean on this philosophy as we discuss specific ways that you can develop your own financial plan. So today's talk is going to be very simple, and the logic should be easy to follow. What I plan to do is deliver 9 brief ideas which form the pillars of our philosophy of advice. And I hope to do that in about 25 minutes or so we can leave plenty of time for Q&A. So as you listen, I'd like you to bear in mind that a lot of this philosophy is going to sound counterintuitive to what you may have learned in the past about investing, and in some cases may even sound downright countercultural. I'd like you to keep an open mind and to embrace the counterintuitive nature of what you're going to hear. So the first of our philosophy is that the only and most effective way you can achieve long-term financial success is by following a written financial plan. So in my 30-year career of advising families on their money, I've noticed two important things. First, there's a significant correlation between people who achieve financial success because they've developed a date and dollar-specific written wealth plan. And second, that sadly, almost nobody in America takes the time to actually do this. The fact is that most of the money that most people on this call are going to save and invest in your lives is set aside for retirement, when the day comes for you to retire, and when there really are only two possible financial outcomes. Behind door number one, which is not a very happy place to be, running out of money in your old age is no fun. Behind door number two is your money outlives you, and you'll get to enjoy the most qualities of life that anyone can ask for: your dignity and your independence. You may even be able to intervene financially in the lives of your children or grandchildren, or the causes that are important to you. The door that you get to walk through is largely dependent upon whether you have a written, date and dollar specific wealth plan that you audio. You're hitting it. Sorry. So the counterculture in this pillar is that in a world where everyone wants you to buy their financial products, what I'm telling you is that it doesn't matter what products you own. What really matters is the act of creating a specific written plan. The second pillar of our philosophy is that the only real definition of money is purchasing power. Most people have a hard time understanding this reality and often confuse money with currency. They mistakenly think that their money is reflected by the number of units of currency that they own. Well, if you think about it, the whole purpose of saving and investing is to set aside some dollars that you decide not to spend today so that you can have those dollars to use at some point in the future. When you do that, you should really make sure that the dollars you set aside today will buy at least the same amount of stuff in the future as that they can buy today. Well, if we can catch up here. This slide shows what happened to the price of a postage stamp over the last 40 years. And I like to use the example of a cup of Starbucks. If I want to buy a cup of Starbucks today, I need about $3. If I want to buy it next week, it's still going to be just about $3. But if I want to buy it in 30 years from now, it's going to be more like $7.50. So if I want to take my $3 from today and still buy my Starbucks then, I need to turn my $3 into $7.50, or else I can't get a venti. Maybe I have to get a tall or a grande or something. In other words, money is really only defined as purchasing power, which is the amount of goods and services that one can get from a dollar at any given time. And currency isn't really money because it loses some of its purchasing power every day due to inflation. In fact, over a 30-year retirement, you're going to watch your cost of living rise by about 250%. So we believe it might be a good idea to have a plan in place to make sure that your income rises by an equal amount. So note the counterculture in this pillar, which is that this right here is really not money. It's only currency. And it's virtually guaranteed to be worth less a year from now than it is today. The third pillar of our philosophy is that equities, what we call the partial ownership of the great companies of the world, have been much more effective than fixed income investments at preserving and actually enhancing your purchasing power. So since 1926, large company equities have delivered about a 10% annual return. The dividend cash flow from those same companies has also grown at a rate of about 5% per year. Over the same period of time, high quality bonds have compounded at about 6% and are today only yielding about 2%. And since 1926, inflation has averaged about 3%. So the real return after inflation of owning good companies, if you will, the margin of safety they've provided above and beyond inflation, has historically been about double that of owning bonds. So if you look at your slide here and you do the math, if equities have returned 10% per year, which is after inflation a return of about 7%, bonds have returned 6% per year, which reduces to a real return of 3% after inflation. A real return of 7% is just about a little more than double a real return of 3%. As you can see on this long-term chart, you can tell the stark difference in long-term wealth accumulation that has occurred for investors in equity markets versus investors in fixed income investments. So this is the fundamental reason why, for a lifetime or multi-generational investor, we much prefer to be an owner of companies rather than a lender to them. So note the counterculture in this pillar, which is that most people think of cash and bonds as conservative investments. But in the quest to conserve our purchasing power after inflation, equities have actually done a far better job than bonds have historically. The fourth pillar of our philosophy is that these equity premium returns, more than double that of bonds, are a function of, and in fact, they're caused by equity volatility. So since the end of World War II, large company stocks have declined an average of almost 15% per year. So let that sink in for a minute. For almost the last 75 years, on average, stocks have had a 15% dip just about once every single year. In fact, one of our favorite slides that we like to use shows, this goes back to the late 70s, and shows each year on the solid blue line how much the S&P 500 rose by in that particular year. And the skinny lines show the range that the market traveled in during that year. Okay, so the thick blue line shows where it ended up, and the range showed the high and low for the year. And what you'll see if you study this chart is that even in years when the S&P 500 has done well, you have moments during that year when the market could slide 10, 15, 20%. Stocks have also been down between 15 and 20% about every 3 years, and by more than 20% once every 5 years. So now we get into the history of bear markets, which this slide shows. And what you'll see is since World War II, there have been just about 16 bear markets, which we define as a decline of 20% or worse in stock prices. The worst one was in 2007, when stock prices from peak to trough went down by 57%. But what you'll notice is that volatility isn't the same thing as risk any more than temporary decline is the same thing as a permanent loss. Today, the S&P 500 stands almost 200 times higher than it was in 1946, when it started the year at about 18. Even the dividend on the S&P 500 is 65 times higher than it was in 1946. So as this chart will show you, declines in stock prices have been temporary, while the increases in values and dividends have been permanent. Premium permanent returns punctuated by temporary declines. This is the story of equities, all in 6 words. So note the counterculture in this pillar. In a world where most investors live in constant fear that they might lose money in the stock market, well, historically speaking, there's no such thing as the risk of loss for investors who have had the patience to ride out these temporary declines in stock prices. The 5th pillar of our philosophy is that the real long-term risk of owning equities is embedded not in the values of the companies themselves, nor in the global economy, but in the emotions of the investor. In the words of investing legend Benjamin Graham, the investor's chief problem and even his worst enemy is likely to be himself. Research shows that the human brain is wired in such a way that makes us naturally terrible investors. In particular, humans instinctively fear that any market decline is the onset of a disaster, even though, as we just learned, all market declines are just temporary. The dominant factor in long-term, real-life financial outcomes isn't so much investment performance as it is investor behavior. Because we're all programmed with an irrational fear of equity ownership, most investors either don't own enough equities to fund their life goals in the first place, or even when they do, they have a tendency to want to sell out of their stocks and panic when volatility strikes. Basically, we are all cavemen. We're all hardwired to have this fight or flight behavior. There's a market research firm called Dalbar, which annually publishes a report on investor behavior, which has become pretty well known in our industry. And pretty much every year for the last 20 years, this study shows that investors consistently underperform their own investments. The most recent study found that over the last 20 years, the average equity fund investor, the average Joe, underperformed the S&P 500 by a margin of about 3.5% per year. Over 20 years, the S&P returned about 8% per year, but the average investor in stock funds only got about 4.5% per year. Historically, these numbers bounce around a little bit, but they've remained pretty much constant. Over 20-year periods, the average equity fund investor consistently manages to capture just about half the return that the market produces. So in a society that's become obsessed with outperformance and finding the next five-star fund, the average investor is not only underperforming the market, he's underperforming his own investments, which happens for a simple reason. It's because the average equity investor is hardwired to jump in and out of their investments at all the wrong times and for all the wrong reasons. In a minute, we'll talk about how 2020 was the greatest lesson for that in history, probably. So the counterculture here is that your own behavior as an investor and your ability to avoid being sabotaged by your own emotions is likely to be much more important than any other factor like picking the right fund. The sixth pillar of our philosophy is that the economy, markets, and future relative performance of investments cannot consistently be predicted. But that's okay, because compared to the way your assets are divided between stocks and bonds and your own behavior, these variables really aren't very important. In practice, the only way to capture the full return of equities has been to ride out their temporary volatility. So this is where things get really countercultural, because there are two huge industries, the investment management industry and the financial media, who are going to constantly bombard you with the message that the only thing that matters to your long-term success is the timing and selection of the financial products that you pick and your ability to find the next five-star mutual fund. If my talk today accomplishes nothing else, I hope to free you from this constant worry about whether you picked the right five-star fund or how the relative performance of your investments stacked up this year. I'm here to tell you that while timing and selection may make up 5% of your long-term investment success, your own behavior is going to make up 95%. The seventh pillar of our philosophy is that no one can consistently gain an edge over the market by going in and out because of current events. We never attempt to analyze or predict the outcome of current events because they're way too unpredictable. Again, think 2020. Instead, we always counsel that if your goals haven't changed, you shouldn't change your portfolio. Of course, it's easy to see the counterculture in this one. All you have to do is remember what happened in the US over the last year and how the stock market has behaved in response. Totally unpredictable. The eighth pillar of our philosophy is that we firmly believe that uncertainty in both the markets and in the world is the only certainty. So I found that most people mistakenly believe that the world is alternately moving from periods of uncertainty into periods of certainty and then back again, and that all we have to do is wait for the next period of certainty to get here. The truth is the world is constantly moving from one crisis to the next. There's always a crisis happening somewhere. When coronavirus is over, there'll be another crisis that'll come along. The world lives in a permanent state of instability. For example of this, one of my favorite slides, Paul, can you back that up one more? This is a slide that shows the last 60 or so years of events that have happened in the world, such as the World Trade Center bombing, the Bay of Pigs, the assassination of JFK, and the steady upward march of the stock market in the face of all those uncertainties and all those things that should be fearful. So we counsel rationality under uncertainty, which just means that history is the best guide to the long-term future. Our firm is guided by two famous quotes. One is from President Harry Truman, who said, "The only thing new in the world is the history that you don't know." And the other is from legendary investor Sir John Templeton, who said, among the 4 most dangerous words in investing are, this time is different. So this point is countercultural because most people don't believe in the rationality of markets. Popular culture and the financial media have taught us all to believe the exact opposite, that markets are chaotic and unpredictable, and that any order we might perceive in the markets may stop functioning at any moment. So while we're on this subject, I want to just take a couple extra minutes to dive a little bit deeper into the impact of current events on investing and what 2020 taught us, because I believe that the last year has taught us some of the greatest lessons that an investor could ever hope to learn. So we all need to accept that we live in an uncertain world, and every day you get out of bed, you're required to deal with some of life's unknowns. However, we believe it's important to remember that there really are 2 kinds of uncertainty. There are the unknowns that we know about, the things we know we don't know. And then there are the unknowns that we aren't even aware about, the stuff we don't know that we don't know. And it's usually this second category of uncertainties that cause our worst problems. So for example, in 2020, presidential elections are perfect examples of a known unknown. Everybody knows that we're going to go to the polls in November of every 4th year. And this event almost always causes a ton of uncertainty and anxiety for a ton of Americans. Obviously, this year's election was no exception to that rule. Because of this uncertainty, particularly this year, and all the media hype about it, many people even decided to sell their equity investments and sit on the sidelines until after the election because of their trepidation over this known uncertainty. They knew it was coming. Unfortunately, those investors who sold in an election-induced panic appear to have made a big mistake. The stock market soared in the month of November and December. On October 30th, the S&P 500 closed at a level of 3269, and by the end of the year, it was 3756, an increase of about 15% in just 2 months. And this year has done nothing but continue that growth. In fact, a lot of the things that many people were worried was going to happen did happen. The election was contested. There was the attack on the Capitol, chaos, mayhem, but the stock market continued to go up. On the other hand, you could certainly make a reasonable argument that there's never been an event that came so far out of left field than the coronavirus pandemic. In many ways, the pandemic has been the mother of all unknown unknowns because it affected almost everyone on Earth and almost nobody saw it coming. Last January, there weren't any newspaper headlines speculating how the pandemic was going to impact equity portfolios. And for that matter, most people hadn't even heard of the word COVID by the time February rolled around last year. However, it's always these problems which come at us from left field, which we're not prepared for, that inspire the greatest degree of panic in equity prices. So when COVID finally did hit the financial markets, equity prices reacted quickly and violently and offered no mercy. The S&P 500 declined by about 34% in 33 days, which was a record for the speed of such a decline. So the important lesson to learn from considering the impact of unknown unknowns is that no amount of economic commentary or market forecasting or research can prepare us for the really dramatic market movements, which almost always seem to come at us from out of left field. The really significant changes in stock prices almost always come as a result of some dramatic and unpredictable event, which no one expected and no amount of analysis could have prepared us for. So trying to make investment strategy out of expert prognostication, turning on CNBC, financial journalism, sets us up to fail. Instead, to be really effective equity investors, we need to simply accept that there are certain risks that we don't even know about, which from time to time are going to strike us by surprise and are going to cause our portfolio to decline by 20, 30, or even 50%. If we're honest with ourselves, we're going to realize that there's really no way of predicting when these risks are going to arise. And most of the time we think they're going to arise, like before the election, they actually don't. The good news is that we can always comfort ourselves in the knowledge that when these unknowns do strike, what always happens next is an equally powerful recovery in equity prices, which drives the stock market to new and higher highs. In this case, after declining by 34% in just about a month back in March, the S&P 500 is now up by almost 65% since that time. Of course, the recovery in equity prices doesn't always happen that fast, but historically speaking, it always does happen. So finally, the ninth pillar of our philosophy to bring this all together is that long-term optimism is really the only reality, and it's not possible to make a good investor out of a pessimist. We believe firmly that an educated optimism is the only outlook that's supported by history. Examples of this are all around us, even though we usually choose to ignore them, and the media typically puts a negative spin on them. So think about this. Cornelius Vanderbilt was the Bill Gates of his age. He was by far the richest man in the world. But he could never have dreamed of some of the luxuries that we enjoy in America today. In the US today, of Americans officially designated as poor, 99% of them have electricity, running water, flush toilets, and a refrigerator. 95% have a TV, 88% have a telephone, 71% have a car, and 70% have air conditioning. Vanderbilt had none of those things. Even more relevant today, did you know that the iPhone was only launched in the year 2007? Hard to believe, but just 10 years ago. Well, when I was born back in 1969, if it was possible to assemble all the technological capability of an iPhone, which it wasn't, it would have cost billions of dollars. Today, everyone on this call has one in their pocket. However, the truly astonishing thing is that even someone with many billions of dollars back in 1969 couldn't have assembled all that technology because most of it didn't even exist. One of my favorite slides is, people usually get a kick out of, is looking at the history of cell phones from really just about the time I was born until today. We used to carry around a suitcase that a phone would sit in the suitcase. Our optimism is based on the instinctive impulse of 7.5 billion humans on Earth to become more, to be, to do, and to own. Capitalism combined with human ingenuity and technology are thriving around the world despite government, politics, financial crisis, armed conflict, natural disasters, religious strife, terrorist atrocities, and yes, despite COVID. It's the combination of our human urge to become more, together with our natural ingenuity, which has driven an explosion in the quality of life for almost the last 10,000 years. I'm very comfortable investing in a future that's shaped by human ingenuity because it's the only natural resource that can never run out. So earlier in the talk, we explored the difference in historical returns between T-bills and bonds compared to the returns that equity investors have achieved. Stocks have produced returns which are multiples of the returns achieved by conservative investments. The reason for this is that equity ownership is the only way to invest in human ingenuity. So here's the counterculture. For some unknown reason, Americans don't think of stocks as shares of companies, which represent a direct ownership of the earnings, cash flow, and assets of businesses that you patronize every day. We don't think of the stock market as a portfolio of businesses with real earnings and real dividends, but instead we see stock prices as inherently unstable. We see stocks not as ownership of businesses, but as casino chips. Always remember that stocks are actually shares of the profits, earnings, and assets of real companies made up of real people with real ingenuity, creativity, and intelligence. So that's our 9 pillars, and let's recap what we know so far. First, the only real pursuit of investing is to preserve or even grow our purchasing power. If I have $1 and I'm going to forgo spending it today to save it so I can spend it later, the wealth I set aside better buy me at least as much stuff in the future as it could buy me today. Second, historically, stocks have done a way better job than bonds have in growing purchasing power by more than double. Third, most people think stocks are risky. I think they're not risky, they're just volatile. Historically, there's no such thing as losing money for an equity investor who has a reasonable time horizon and the fortitude to ride out the temporary ups and downs in equity prices. 4, this is not to say that stocks aren't volatile, because they are. Historically, they pull back by roughly 10 to 15% on average once a year. And once every 5 years, they're going to pull back even worse by something like 30 to 50%. 5, they have always recovered from those pullbacks and then moved on to new higher highs. Since 1945, there have been 15 bear markets of as much as 20 to 57% decline. Every single one has recovered and moved on to a new high. In 1945, the S&P 500 was 20. Today, it's 3,800. And 6, On average, no matter how bad the bear market may be, the average bear market has recovered within 5 years, just about 40 months to be precise. 7, trying to buy and sell your equities based on what you think stocks will rise or fall due to current events is a foolish pursuit. Markets are always unpredictable, and it's always the unknown unknowns that cause the worst market pullbacks. So armed with this knowledge, the smart long-term investor might see that declines in stock prices are not moments to become paralyzed by fear, but they're actually opportunities. Since every bear market in history has bounced back and recovered, these times might be seen as moments when stocks are on sale and you can get them cheaper than usual, like last March. So with these historical facts in mind, our firm has developed a very simple but effective strategy for how we recommend to allocate your investment capital between stocks, bonds, and cash or money market funds. And this is really a bunch of the questions we had were related to how to invest going into retirement. This really hopefully will help people to think about if they're going to be needing cash flow in the course of the next 5 years or so, how you might think about allocating your portfolio to deal with your retirement distributions. So we call it time-based allocation, or in simple terms, our bucket strategy. So here's how it works. Oops, Paul, can you back up to the buckets? So the first thing we do is we look at your entire financial wealth and we divide it, all your money, into 3 separate buckets allocated by time horizon. First, we calculate the amount of money above and beyond your normal earned income that you think you might need to draw from your investments to pay expenses that may come up in the next year. And we call that your short-term bucket. We place that amount in cash so we know that it's safe and it won't fluctuate, kind of like an emergency fund. Next, we calculate the amount of money above and beyond your normal income that you may need to withdraw from your savings in the next 5 years. And that amount goes into high-quality, short-term bonds, so we know this money will be there when you need it, and it won't be volatile. Finally, any dollars that we reasonably believe that will be set aside for longer-term needs that are more than 5 years down the road, like college for the kids or retirement, goes into equities, the long-term bucket. Because this bucket of money has a time horizon of 5 years or longer, and because we believe that most market pullbacks will be over and recovered within at least 5 years, we feel comfortable allowing this bucket to grow while we ride out the short-term ups and downs of the stock market and take your daily bread, take your living needs out of the first 2 buckets. Then every year, once a year, we manage the allocations of those buckets. If you actually did spend some of the money out of your short or medium-term buckets and need to replenish those, we harvest some of the gains out of the long-term bucket to refill the medium and short-term buckets. Of course, we only do that if the long-term bucket actually went up in value that particular year. We harvest when we had a crop. If the long-term bucket went down in that particular year or declined in value, we take a year off. We don't harvest while it's down. We don't sell while they're down. And we allow the short and medium-term buckets to get a little short, right? To get a little underfunded, with the intention that when the market does recover, which it always does, we will then catch up. We'll true that up with an extra distribution from our growth bucket when we need to. So I'm going to open up to questions in a minute, but before I do, I just want to bring this whole discussion together by giving you a visual analogy that I think is the best description of equity investing there is and how to accumulate, really how to accumulate wealth. And it's an analogy of a tree. So you plant a tree in the earth, and all of a sudden, nature causes it to take root and to grow. You don't have to do a whole lot with it. The air and the water and the nutrients it needs are all around it, and it knows how to use them. You certainly don't dig it up every 90 days to check on its progress, and you don't uproot the tree and store it in your garage over the winter to protect it from what you regard as bad weather when it looks like it's dying. Although the leaves fall and it may stop growing for a season, the tree doesn't die. If you just give it enough room, enough light, and enough time, and leave it pretty much alone, it will grow and give you back the shade and beauty as it grows, and may even go on doing so for your children after you're gone. Well, investing's the same thing if you let it be. Wealth is no less organic than that tree. The growth in equities is no less a force of nature. So I hope that philosophy is helpful. And now I would be more than happy to answer any questions you may have, which as Paul mentioned, we did have several that came in advance. I will try to take any that are sent in, but we've got quite a few that were already sent in, so we may not get to that. So as an old man, I do now have to wear glasses to read, so here we go. Best investments when you have only 5 years to retire. So hopefully the discussion of the buckets gave you a start on that one. As we have clients who are nearing retirement, up until 5 years prior to retirement, we're really focused on, if you think about the life cycle of an investor, I'm working, I probably have 10 more years to work. So right now, I feel like my earned income is sufficient to cover my lifestyle. And I'm not drawing anything out of my investments, okay? And I don't plan to for probably 10 years. And so as a result, almost everything I own is in equities. If I were now 3 years from retirement, what I would probably do is say, well, in year 1 and year 2 of retirement, I plan to spend a total of, $300,000. So what I better do is take $300,000 out of my equity portfolio and put it into my medium-term bucket, because those are expenses that are 5 years or closer, and invested in bonds that will be coming due in the 3rd and 4th year, okay? And then keep everything else in equities. And then next year, I would do the same thing until I fill up my medium-term bucket, so that on the day I retire, I can retire feeling confident that I've got my 5-year bucket full, and that everything I have in equities has at least a 5-year time horizon to continue growing. And the main part about that is I do know that just because I've retired at age 60 or 65 certainly doesn't mean that, number one, I probably won't live another 30 years. Either my wife or I will most likely live to 90 or 95 years old, and that over that period of time, our cost of living is going to rise by almost 3 times. So equities still definitely need to be a big part of my plan, or else I've got no shot of keeping my income up with inflation. A few ideas to create passive income. My favorite passive income source is equity market dividends, primarily because there's not a whole lot of management that I need to do, and mainly because equity market dividends are magic. They grow, okay? So historically, the dividend yield on the S&P 500 has grown at a rate of just about 5% per year. So even though maybe today your dividends on your S&P portfolio might be 1.5% or so, 10 years from now, those dividends are going to be double, close to double, and then another 10 years are going to be double again. So the reason I love equity dividends is because I get a growing stream of income, okay? Most other sources of passive income are kind of a locked in or static source of income. My personal opinion, bonds today are uninvestable, given where interest rates are. I couldn't justify to my clients making a significant commitment to investing in bonds, given what the outlook is for inflation versus what bonds are paying right now. I believe that bonds have a very little chance of beating inflation over the coming years, partially because of what's happened, with COVID and so forth. So equity dividends are my favorite. Certainly, real estate investment is certainly a valid way to produce passive income as well. I personally, unless you're going to go out and manage and buy and sell your own real estate properties, we particularly like using either private real estate investment funds, or there's a product called non-traded REITs, which are a way to actually participate in the actual value of that real estate as opposed to a stock in the stock market that's trading around real estate investment trusts. So, but anyway, investment real estate is another good way to produce passive income. Tips for planning to retire in the next 5 years. Hopefully that what I just described might be helpful. Effective strategy to estimate your monthly and annual living expenses in retirement. It seems like guesswork. Yeah, it is. not easy to estimate what your expenses will be in retirement. Actually, next month, our session is going to really focus on that and talking about how to at least get a ballpark. The first thing I'd say is that generally speaking, typically, most people spend just about the same in retirement as they spend in younger life. Because what ends up happening is much of your lifestyle stays the same, but the parts of your lifestyle, like for example, paying tuitions for kids, might be replaced by joining a golf club or going out to dinner more. So some of the things that people, traveling more in retirement may take the place of some expense that you may have had earlier on that goes away. So we usually like to just say, hey, what are you spending now as a rule of thumb? The key element though is not to obsess over it. It's an inexact question, right? You're never going to get it right. Like every time we sit down with a client and we try to model out what they're going to spend in retirement, they always spend something different in retirement than what they model for. It's an inexact exercise. So don't let the inexactness of the exercise prevent you from actually doing your financial planning and running your numbers. Pick a number, model out, plug the number into your financial planning software or a spreadsheet or have us do it, but just pick a number and don't let that be the obstacle that holds you back from actually taking action to execute a financial plan. Look, it's like, I've used the analogy often that writing up, you can sit down and write up a workout. You can go log on to beachbody.com and P90X and write out the best workout program in the world. And guess what? You're not going to get in shape unless you go to the gym and start working out, right? I could have a crappy workout program, but actually go to the gym and outperform Jack over here, who has the best workout program in the world, but spends all his time writing his workout program and doesn't actually go to the gym. And financial planning is no different. Take action. That's the most important part. Explain the types of life insurance and when they might be beneficial. So, the most common and I think most effective for 99% of people on the call is term life insurance. So we have a belief that really the best, the most important need for life insurance is to protect your life, right? So to protect your family in the event that you're still a breadwinner and you die prematurely. And term life insurance is really great for that because it's cheap and you can insure yourself for a term of time, then you can stop paying for it. So for example, you might say, I'm going to insure my life until I decide, until I plan to retire, which is 20 years from now. So I'm going to buy a 20-year term insurance policy. And because the policy lapses after a certain period of time, the drawback is it goes away. The benefit is it's a lot cheaper, right? So term life insurance is much cheaper, and it's a great way if you just want to buy pure death protection, protect your family. There are other types of products, for example, whole life. There are variable universal life. There are different products that allow you to basically the entire suite of other insurance products. What they're basically doing is they're allowing you, when you pay a premium, part of your premium goes to pay for the actual death coverage, for the actual death benefit, and part of the premium goes into a side bucket that's kind of like an investment fund that's attached to that life insurance contract. Generally speaking, all these other so-called permanent policies, that's what they do. When they do that, one of the things is that that side bucket, if you pay into it enough and it grows enough, might get big enough where it can actually fund the premiums for you on an ongoing basis. So that it could reach a point in time when you could stop paying in, but the policy will continue because there's enough cash in that policy to continue supporting the death benefit over time. One of the benefits of cash value life insurance, that cash bucket, is it's also tax favored. It's tax deferred, just like your 401k plan may be. So as it grows, you don't have to pay taxes on the growth of it. And there are some ways you can actually withdraw that cash later on in retirement, let's say, in a tax favored way. So there are some interesting ways to do that. Generally we prefer to say, when you're just getting started, max fund your 401k plan, buy term insurance to protect your death, possibility of death. maybe as your planning gets more sophisticated, you could start looking at some of these permanent insurance products as a way to help fund your retirement and also provide some death benefit. Home equity lines of credit, good or bad idea? I would say that we actually are going to do a program later in the year on debt management. As far as home equity lines are concerned, yeah, I mean they're a valid and valuable way to access cash in a pinch if you need money for tuitions, home improvement, et cetera. Right now in today's world, my general advice is, because rates are so low, and I personally have a concern that a lot of what we've done with printing all this money in Washington may spark, some inflation, which may spark interest rates to rise. Always remember, a home equity line has an adjustable variable rate of interest attached to it. So even though you may be paying, 3% today on your home equity line, it could go to 5, 6, 7%. So you've got interest rate risk. So I prefer, especially right now, locking in, refinancing. Very common situation maybe is you've got a cash need. Maybe you want to do a home improvement. Maybe you have a 4% 30-year fix right now, which isn't a bad rate. But what you could do is refinance the whole thing, especially because house prices are up right now too. Refinance your whole mortgage. Maybe take some cash out, take a slightly larger mortgage than you have now, take the cash out to do your home improvement project, refinance the whole thing into a new 30-year fix, maybe at a lower rate, maybe in the mid threes. You reduce your rate, you got a little bit of cash, and maybe you get lucky, maybe your cash flow stays about the same because that rate's lower. So that's, I personally prefer right now looking at fixed ways to lock in interest rates.
And Eric, if I could jump in there, you would say that's for people who plan to be in their home, right? Don't go do this. If you're planning on moving in 5 years, don't go potentially jumping into a 30-year fixed mortgage where you're only paying interest for the first 5 years anyway, right?
Yep. How do you jump the hurdle of just getting started, if that makes sense? And there were a few questions about just getting started. I got to tell you, get started, right? Do something, start saving, even if it's a little bit every month. Particularly your 401k plan. Your 401k has so many benefits that others are helping you to grow wealth, right? So every month, if you put a little bit of your paycheck into your 401k plan, number one, that is a pre-tax contribution. So Uncle Sam, you put $1 into your 401k plan, $1 of your comp. Uncle Sam doesn't get his hands on one single penny of that, okay? The whole dollar goes into the plan. So you're, number one, you're getting a break from Uncle Sam. And number two, there's a good chance maybe your employer may have some sort of match, okay? So not only is $1 going in, but maybe your employer's matching that with a little bit of contribution as well. So $1 of your paycheck turns out to be, whatever, $1.10 or something like that, pre-tax. So if nothing else, do your very best to get as close to you can as to maxing out your 401k. That's step number 101. And even if you just contribute a small contribution to start with, and you start getting used to it, just start signing up for your 401k. That's probably my best advice for how to initially get started. Investing in rental properties. We touched on that a minute ago. One of the things with rental properties, certainly a valid way to grow your wealth, great income, and you can get appreciation. Problem is, it's a much more active strategy, right? Like, I can invest in the S&P 500. I don't have to do a thing, right? I mean, I don't even have to do anything. And the returns I talked about earlier, just about 10% per year over time, have been what I've gotten, okay? Which is pretty good. Right. Now, with the volatility we described, I can go invest in rental real estate and to get whatever return I got to get, when my tenant's toilet breaks, I gotta go out in the middle of Sunday night and fix the toilet or whatever. So we're having property management to do that. So it's just there's more management, more hassle. To probably takes more of a time commitment, but certainly a very valid way to invest and grow wealth. How should I invest 20 grand of cash sitting around my savings account? Pretty simple. If it's cash that you feel like you can kiss goodbye for 5 years or longer, put it in the equity market, put it in the S&P 500. I would personally blend it, some domestic, some international, some small cap, some large cap. But if you can really honestly tell yourself, I'm willing to put this money away for longer than 5 years, equity market. Shorter than 5 years, right now I'd keep it in a money market fund and try to continue to build it to a point where there's enough there that you could say some of it goes into my 5-year bucket. Remember those buckets. That's for us, that's everything. How to roll my IRA into a Roth and tax implications. So this is a good one. As people may know, there's two types of IRAs. There's the traditional IRA, and then there's what's known as a Roth IRA. The Roth IRA is, while the traditional IRA, your money goes in deductible up front. So if I contribute $1 to my traditional IRA, I get a $1 tax deduction in the year I put it in. Then once it's in, it grows tax deferred. I don't pay any capital gain taxes on it as it's growing. But then when I take it out, I have to pay income tax on whatever I take out. Okay, it goes onto my tax return as income tax. In a Roth IRA, what happens is when I contribute to it, I don't get to take a tax deduction. I'm contributing after tax dollars. Once it's in, it grows tax deferred. And then on the back end, when I pull it out, I pay no tax because I already paid my tax up front. Okay. And, you can make an argument actually that Roth is better, especially if when you retire, if you're in a higher tax bracket than you are today, which may happen because tax rates may be going up. So anyway, there's also a strategy where for those who have money in a traditional IRA, you're permitted to roll that money over into a Roth IRA, okay? And the reason you would do that is you might say, well, I believe that either my personal tax rate or just tax rates in general are going to be higher when I'm retired, okay? And that may be a very valid belief. And so I'd rather pay the tax now on this money than I would pay it when I'm 70, okay? Because I think when I'm 70, tax rates are going to be higher. So if I pay the tax today, I'm going to get off a little cheaper. So what the government allows you to do is to do that, is to take, I got $100,000 in a traditional IRA, I pull my $100,000 out, and I roll it into a Roth IRA. Now, once it's in the Roth, when I finally do choose to take it out, I don't have to ever pay any taxes anymore. The catch is when I do that conversion, when I take the 100 out and put it into the Roth, that 100 shows up as ordinary income on my tax return in this particular year, okay? So definitely a valid strategy. What I would say the thing to look out for is, again, you may argue that down the road, you may be in a lower bracket or a higher bracket, and this is why you're doing this. But what also can happen is that 100 that you rolled out could actually throw you up into a higher bracket this year. So if you're not in the top tax bracket this year, taking out that 100,000, it actually goes on your tax return, and so it's part of your calculation of your adjusted gross income, and therefore could bump you up into a higher tax bracket than you otherwise would have been. So you may end up paying, kind of more tax on that than your current tax rate is, and so you have to factor that in when you're looking at what future tax rates might be. Well, yeah, will they be higher than what this bracket that this is going to throw me into by doing this transaction? So there's some math around it, right? This is not one that I could just kind of answer like as a blanket that it either is or isn't the right thing to do. It is somewhat custom to your current situation, and we can help you to think about that. But those are the key issues. How to start using your 401k after retiring. So again, this buckets idea. Here's the thing about 401k with respect to investing, in my opinion, is for most people, certainly for most working people, your 401k plan really should be all in equities, right? I mean, if you're 30, 40, even 50, 55 years old, retirement is probably, at least 5 or 10 years out from now for many people, and maybe even 70 by the time you start pulling out of your 401k plan. So the vast majority of 401k funds in this country are owned by people who aren't going to, in fact, you can't, without big tax penalties, take that money out, in the near future. Like it's locked, it's long-term money. So it should, there's no reason that your 401k plan shouldn't be in the equity market. Remember, it's going to be volatile, but over that long period of time, at least historically speaking, it's going to produce a superior return. So one of the things as you're in retirement or getting close to retirement and you're trying to construct this buckets concept I was describing, if you've got some resources in your 401k and some resources that aren't in your 401k, like a brokerage account or something, generally what we try to do is to say, well, construct your short-term and your medium-term buckets out of your brokerage assets, your non-401k stuff, and keep the 401k in the long-term bucket as long as you can, because why start taking money out of that 401k plan before you have to? Because when you do start taking it out of the 401k plan, it's coming out as taxable income. So postpone the taxation of your withdrawals for as long as you can. Treat your 401k plan as it's the last money on the ladder of what you would want to withdraw from. Your taxable brokerage assets are definitely first on that ladder, and then IRAs, annuities, 401ks come because they're taxable income. When they come out, you have to pay tax on them. So take the stuff first that you don't have to pay tax on. I'm 60 years old this year. What are my chances of creating wealth at this time of my life? Well, I mean, hey, especially if you're still working, you certainly, it's never too late, right? I mean, especially if you're still working and earning, you create a budget, you create a financial plan. It's never too late to at least, you may not be a multimillionaire, but saving will put you in a better state later than you otherwise would have been. So save something, put something away.
Eric, if I could add to that, we've got a couple questions along those lines. That if you came to this webinar looking for us to give you a magic answer to how do I turn, I have no money and I'm retiring in 5 years into a bunch of money, we don't have that magic. What we can say is spend less, save more, right? It's not sexy, but
there are a bunch of questions. I'm 51, I'm 54, is it too late? Is it too late? Tell yourself it's too late and believe that and buy it, and you'll never get anywhere, right? I mean, it's just like, Henry Ford, if you think you can or you think you can't, either way, you're right? It's never too late. It's never too late to do something to improve your situation. Now, it may not improve it to the point that you might hope to improve it, but it's going to make it better than it otherwise would have been. So it's never too late to do something to improve your financial standing. Create a budget, figure out a way to do something to set some money aside for your future and invest it, okay? This one I liked because it draws out, I think, a good point. I'd be interested in learning how to research and purchase stocks on my own. So we are not, as I said before, if investing success is going to be 5% research, right, and 95% behavior. I always like to say, if my associate Jack, who's standing here and you can't see, he's a real research nut, right? And he's a real spreadsheet guy, and he goes out and he spends hours at this, and he finds the fund that is going to be the top performing stock market fund for the next 10 years. Okay, let's say this is last January. Okay, and I am a Dumbo, right? I don't care. Just get me in the market, right? And I just put my money in the S&P 500. Okay, and last March we both invest, and by the end of March, the market's down 34%, and Jack freaks out because of coronavirus, and he sells his fund. Okay, and I, like a Dumbo, I say, whatever, it'll be fine. And now I'm now up 65%. Who won, right? What good did all that research that Jack just did? okay, because he made an emotional behavioral mistake. The fact that he picked the best fund with his brain, okay, did him no good because his emotions caused him to make a mistake in which he won't reap the rewards of all that research. So picking stocks, picking funds, I can't emphasize enough the amount of wasted time. Let me put it this way, it distracts people from what's really important. People are so focused on finding that perfect investment, that perfect fund that's going to be the 5-star fund. And that pursuit distracts them from, getting started with the savings plan or managing their behaviors properly, not freaking out when the market, goes down or whatever. So focus on those things. Don't focus on, particularly with respect to owning individual stocks. One of the things that we really are big believers in is diversification. When you go buy an individual company stock, let's say, you may have done a bunch of research, and what you're trying to do is to give yourself an opportunity that stock or that handful of stocks you bought might do better than the market, okay? But you're also opening yourself up to the possibility that you were wrong and they might do worse than the market, okay? And in fact, if you look at the history of active money management, most money managers, most professionals underperform the market. So you have a lower chance of doing better than the market. Doesn't mean you won't do better than the market. It just means you have a lower chance. Most people are not successful in doing that. So what I say is, why try? Why waste my time trying? And especially because with individual stocks, unless I've got a lot of money, I can't buy enough of them to properly diversify, okay, to give me the chance that I own enough different companies to make up for the mistakes that I might have made, okay? The smaller the number of stocks I have, the greater the chance that a mistake that I might have made is gonna hurt me. The bigger the number of stocks I have, the less the impact any one of those stocks in there is gonna hurt me if it was a mistake, okay?
Eric, so we're running on a little over an hour now, so maybe there's a couple more questions and
Okay.
then we'll call it for the day.
I just want to see here if there's any that are particularly good.
There's one that I had that I think would be good. I know you've kind of made the point, but again, what's the average amount of time for the market to bounce back? I think this goes to why we use 5 years.
Yeah. So yes, 5 years really. I mean, again, I really believe that if you armed with information, you can turn fear and trepidation into opportunity, right? And so the information that I know is that historically, now this doesn't mean that this is always going to hold true in the future, but historically, some pretty bad bear markets, okay, throughout history, and they've always been back within 40 months. Well, the average has been back within 40 months. So I'm not saying that any bear market that happens is going to recover in 5 years. What I'm saying is that there's a very good chance that any bear market that happens is going to be recovered within 5 years. So what that empowers me to do, okay, is last March when the S&P 500 was down 34%, okay, and everyone else around me their hair was on fire. People were, we had clients calling us, we need to sell everything. Oh my God, what's going to happen? Well, when you look at it through the lens of history and logic, you say, well, if the market was at, 1 and now it's at 0.6, okay? And with my logic, it's going to be back to 1, within 5 years, but I'm getting to buy it today for 0.6, right? I've just built in a premium on my investment return over the next 5 years. If it just gets back to where it was in January, I'm going to achieve a return of, something like 6%. So I'm buying at a discount. Now, if I don't believe it's coming back within 5 years, then that whole logic falls apart. But I believe that there's almost no chance, coronavirus or not. Like, our thought was in last March, okay, coronavirus is hitting. It's bad. Obviously, it's bad. Is there any chance that within 5 years, there's not going to be some sort of effective therapies or vaccine? My personal view with what's going on in medical technology today, there's no chance.
Absolutely no chance. Now, it doesn't mean a lot of people won't die. It doesn't mean it won't be really super scary, all of which it has been. But within 5 years, will we be back to some semblance of normal because medical technology will have solved this thing? I mean, to me, there was almost no chance that would happen. So with a proper time horizon, I can look at that as an opportunity to get stocks on sale. When everybody else, I mean, one of my favorite quotes is the Warren Buffett, get greedy when everyone else is fearful and get fearful when everybody else is greedy. Well, back in March, everybody else was fearful. So that 5 year, my view, that 5 year number is everything. It's the key to successful investing, really. If you can slot your dollars into the time that you plan to spend them and invest them appropriate to that time horizon, you will be a successful investor. Okay, so the last one I did want to hit, and we are going to touch on this in a future webinar, but it's probably relevant to a bunch of people on the call. There were several questions about it, and it had to do with credit card debt and how to tackle credit card debt. So I would say, okay, so first of all, if you're carrying a credit card balance, odds are you're paying something in the teens, right, in interest, like probably the high teens in interest. It's the rates on credit card debt are by far the highest borrowing rates that you can pay. So the first thing you want to do is figure out, do I have the means to pay that debt off? I mean, obviously the best thing to do is if you have cash sitting around, never have cash sitting around and a credit card balance. Take the cash and pay the credit card balance off. I mean, some people have like, well, I want to have my savings, my emergency fund, but I'm paying 18% interest on my credit card bill. That's an outstanding balance. No. Take the cash that you're earning nothing on, take it and pay off the 18% interest credit card and start from scratch and building your savings fund. If you don't have that and that's not available to you, what might be available to you if you are a homeowner and you've got some equity in your home, we talked before about home equity lines of credit. You could probably get a home equity line of credit for, 3-4%, something like that. What you could do is take a home equity line of credit against your house and use that money to pay off the debt. It doesn't make the debt go away. It just makes the interest rate go from 18% down to, whatever, 4% or something like that. So that's definitely something that you can do. And in fact, in some cases, we have seen clients who even, if you have a big balance in your 401k plan, you actually can borrow against your 401k plan. And for some people, not always, but it actually may even make sense to take a loan against your 401k plan if you've got a really big credit card balance and pay that credit card bill off. Now, you still have to pay yourself back that 401k loan, but at least you're paying yourself back, and that is also at a lower rate of interest. So credit card debt is evil. It's literally the kind of the worst. It should be your number one priority if you have it. If you have credit card debt before you do anything else, before you save in your 401k, before you build an emergency fund, anything else, figure out a plan, monthly program, just put a little bit a month, whatever you can do to just start working down that credit card balance. Eliminate that, because at that rate of interest, you never pay it off. I mean, this is why people get underwater with credit cards and they can never crawl out because those rates of interest are so high. So that's a priority for anybody that has it. And like I said, we're going to do a future debt management webinar later in the year. So the last piece of this, just before I close, just to take a moment to talk about the program as we continue through the year. So today, as I mentioned, today's just the first in a monthly series that's going to last all year throughout 2021. Jack, can you run that for me? So on the third Wednesday of every month at 2:00 Eastern time, we're going to host an educational webinar series. The mission of this program is going to be to help you to create your own written financial plan to achieve financial freedom someday. So the webinar series is going to walk you through a step-by-step process for how to do that. And we're going to provide you with some advice and information on the primary risks that exist to your financial success. So premature death, disability, taking on too much debt along the way. So if you listen in progression, we're going to try to walk you through, the same process that we go through with clients of our firm to end up with a solid financial plan and the information that you need to execute it. They're all free. All these webinars are free. They're provided by your employer, courtesy of Wellworks. And all you have to do is tune in and watch every month. We're going to have recordings of them as well. So if you miss them, you can catch up. And I promise by the end of the year, you will have the knowledge you need to draft and follow your own financial freedom plan. So the next webinar will be on February 17th at 2 o'clock Eastern time, and we look forward to seeing you all then. Thank you.